Welcome back, XTRM Finance Fam. Today we're diving into a financial hack that's so under the radar, it might as well be wearing an invisibility cloak. We're talking about permanent life insurance policy loans. If you've ever wondered how to borrow from your own life insurance policy and make it work like a personal ATM without the guilt of hitting up your savings, this is the video for you. So grab a coffee, a pen, and maybe your life insurance paperwork, because by the end of this hour, you'll know how policy loans work, when to use them, and the sneaky pitfalls to avoid. Oh, and don't forget to subscribe, like, and comment below. We love hearing from you. Let's start with the basics. A permanent life insurance policy loan lets you borrow against the cash value of your policy. Think of it like borrowing from your future self. What's cash value? It's the savings component of certain life insurance policies, like whole life or universal life, that grows over time. How does the loan work? You're essentially taking an advance on the cash value, and here's the kicker: you're not actually withdrawing the money. The insurance company loans you their money, using your cash value as collateral. It's like borrowing your friend's ladder to clean your gutters, except you own the ladder and they charge you interest. Make sense? Why borrow from your policy? Well, here are some solid reasons. 1. Low interest rates. Policy loans often have lower rates than credit cards or personal loans. 2. No credit checks. Your insurance company doesn't care about your credit score. You're borrowing from your own money. 3. Flexible repayment. You set the schedule or don't repay at all. More on that later. But let's keep it real. Borrowing from your policy isn't a free pass to buy that jet ski you've been eyeing. It's best for emergencies, investments, or strategic financial moves. All right, here's the play-by-play. First, build cash value. You need a permanent life insurance policy with sufficient cash value. If your policy's only a couple of years old, you might be out of luck. Second, request the loan. Contact your insurer and request a loan. They'll let you borrow up to a percentage of the cash value, typically 90%. Third, interest payments. The insurer charges you interest, which can be fixed or variable, and it accrues over time. Finally, repayment options. Pay it back at your leisure or don't. Unpaid loans will reduce your death benefit. And voila! You've got cash in hand with no strings attached except the interest. Before you run off to fund your dream trip to Bora Bora, here are some rookie mistakes to dodge. 1. Borrowing too much. If your loan eats up most of your cash value, your policy could lapse. No cash value equals no policy. 2. Ignoring interest. Even if you don't repay the loan, the interest piles up like that gym membership you forgot to cancel. And 3. Skipping repayment. Unpaid loans reduce your death benefit, meaning your heirs might get a lot less than you planned. Now that we've covered the basics, let's talk strategy. When is a policy loan a good idea? 1. Emergency expenses. Need cash for medical bills or home repairs? A policy loan can be a lifesaver. 2. Investment opportunities. Use the loan to invest in something with a higher return, like real estate or your side hustle. And 3. Tax-free income. Technically, policy loans aren't taxable, which makes them a sweet option for supplementing retirement income. Pro tip: always run the numbers. If the loan interest is higher than your expected return, it might not be worth it. All right, finance pros, this part's for you. Let's talk about some next-level uses for policy loans. First up, arbitrage opportunities. Borrow against your policy at a low rate and reinvest in a higher yield opportunity. This is like playing financial chess. Next, estate planning. Use loans strategically to fund estate taxes or trusts without selling off assets. And lastly, retirement income. Combine policy loans with other strategies like Roth IRA withdrawals for a tax-free income cocktail. Just remember, this is advanced stuff. Consult a financial advisor to avoid turning your policy into a financial train wreck. Policy loans aren't all sunshine and rainbows. Here are the risks. Policy lapse. If the loan balance plus interest exceeds your cash value, your policy could lapse. Reduced death benefit, your beneficiaries might get a lot less if you don't repay the loan. Compounding interest. If you're not careful, the interest can snowball and eat into your cash value. How do policy loans stack up against other borrowing options? Credit cards. Higher interest rates and strict repayment terms make policy loans a better choice for big expenses. Personal loans. These require credit checks and come with fixed repayment terms. Policy loans are more flexible. 401k loans. Borrowing from your 401k hurts your retirement savings. Policy loans don't touch your investment growth. Winner? Policy loans if used responsibly. Let's bring this home with some real-world scenarios. Scenario 1. Sarah uses a $20,000 policy loan to pay for her child's college tuition. She repays it over 5 years, keeping her death benefit intact. Scenario 2. Mark takes a $50,000 loan to invest in rental property. The property generates enough income to repay the loan and build his portfolio. The key takeaway? Policy loans can work wonders if you have a solid plan. So there you have it, permanent life insurance policy loans demystified. Whether you're a beginner looking to unlock the basics or a seasoned pro searching for advanced strategies, policy loans can be a powerful financial tool. Got questions or a story to share? Drop them in the comments below. I'd love to hear how you're using policy loans in your financial journey. And hey, don't forget to hit that like button, share this video with a friend, and subscribe for more money-smart tips. Thanks for watching XTRM Finance, where we turn complex money topics into financial confidence. See you next time.